Hi, I'm George Coyle, the founder of Triangulated Capital Management, and today I'm going to do the first in what will be a new series about traditional investing, where I'm going to explain to you how traditional investing works. I've got a little presentation put together, so I'm going to switch over to that now, and I'm going to keep myself as a little person down in the corner, so you can see me down here. Anyway, so we're going to talk about buy and hold investing, and I'm going to explain exactly how it works for the most part. Uh, and here are the gears so you can see the underlying workings. Okay, so buy and hold investing is also called indexing, but it's pretty simple. You buy something and you hold it. That's the real logic behind it. So easy peasy. The difficult part becomes, what do you buy and hold? And there's a guy named Harry Markowitz. Here he is giving us not quite a mean mug, but an interesting look. And he is the brains behind something called modern portfolio theory. And modern portfolio theory is essentially a method that is used by the vast majority of wealth managers to find your optimal investment portfolio. So how does MPT work? Well, it starts off by finding historical returns for stocks, bonds, gold, different asset classes, and it then calculates the average return and the volatility, typically measured by standard deviation, of each asset. Once these have been put together individually or as different portfolios, you can get a little table like we see here where you have the return and the volatility. So for the S&P 500, the average return over about the last 100 years is just shy of 12% with a volatility just shy of 20%. The 10-year bond has an average return of about 5% with a volatility of 8%. A 60-40 stock bond portfolio, 60% S&P 500, 40% 10-year bonds, does about a 9% return with a 12% volatility. So once you put together a big collection of these different portfolios, you can begin to plot them, as I've done here. So you can see that we've got an X and Y axis, and the Y axis is showing the return. The X axis is showing the risk, which is standard deviation essentially. And you can see, based on the numbers that were in the previous chart, the S&P is at the top right, so it's got the highest return but the highest level of volatility. 10-year bonds are in the bottom left, so they've got the lowest return but also the lowest volatility. And then a 60-40 stock bond portfolio is somewhat in the middle. So this is really just meant to illustrate that you get the returns, you get the volatility, and then you plot each of these portfolios on a two-dimensional graph. Then you can add a lot of other assets. So it might be gold or emerging markets. You can also do different weights. You could do 60-40, 70-30, 50-50 stocks, bonds. You could do 30 gold, 30 stocks, 30 bonds. The possibilities are really endless. But you can wind up with a whole lot of portfolios that you can plot, and you'll wind up with a bunch of dots on the same two-dimensional graph, which you see here. Excuse me. Eventually, you can create thousands or tens of thousands of portfolios, and you wind up with a very busy scatter plot like the one that you see here. And what you find is that there is an upper line, an upper bound on any of these portfolios. So for any given level of risk, there's a highest return portfolio. And the line that connects all of these highest return portfolios for a level of risk is called the efficient frontier. And essentially, portfolios that live on the efficient frontier are the most efficient portfolios for that level of risk. So before we move to that, for 24% annualized risk, the portfolio up here has just shy of a 20% return. I don't know if you can see my mouse, but you can also get one that has south of 10%. So for that same level of volatility, which is considered risk in modern portfolio theory, you want the portfolio that returns the most for the same level of risk. So the logic here is really what governs target date funds. And what target date funds traditionally do is they basically slide down the curve from upper right to lower left as you get closer to retirement and into retirement. So here's a chart from Vanguard that really shows the breakdown of a portfolio based on your age. And you can see over here on the far left, when you're 45 years away from retirement, you essentially have 60% US stocks, somewhere like 30% international stocks, and then 10% nominal investment grade bonds. And as you get closer and closer to retirement, you can see that bonds become more and more of the portfolio until you're in late retirement, when bonds become pretty much the bulk of the portfolio. So, with MPT, the question becomes, well, which portfolio should I choose, if you don't want to use one of the target date funds? And really, the answer depends on each individual's proximity to retirement and their risk tolerance. But in the real world, the truth is, if you're not doing a target date fund, and even if you are, the vast majority of allocations live somewhere between 60% stocks, 40% bonds, and 90% stocks, 10% bonds. So then the question becomes, well, which one is right for you? And the answer is, there really is no one right answer. It depends on your personal goals, your temperament, and what kind of ride you can take. So what's my opinion? My first opinion is that, the right portfolio for you depends a lot on you. But if it were up to me, what I would say, if I was a buy and hold guy, which I am really not, and I'll get into that in subsequent videos, if I wanted to maximize my ending value, I would probably allocate my portfolio 100% to the S&P 500 if I was using a traditional buy and hold approach. If I wanted to minimize the volatility, I would focus on a 60-40 portfolio where I'd be 60% stocks and 40% bonds. And I could also potentially be somewhere in between if I didn't want to be at the extremes. So 70-30 stocks, bonds, 80-20, et cetera, et cetera. But the bottom line is, like a spouse or a car, only you can decide what's right for you. That said, the other thing that I would make sure to do is to use low-cost ETFs or mutual funds to represent stocks and bonds. And my logic behind that relates to two different guys. The first is John Bogle, and he started Vanguard in 1974 with a simple idea. I guess two simple ideas. The first is that low-fee passive indexes typically outperform the vast majority of managers. I think the number back then was 90% or so of managers underperformed their benchmark index. And the second was that if you buy a diverse basket of stocks or bonds, you remove company-specific risk. So diversification was a way to get away from single risk in any given stock. And almost 50 years later, his ideas pretty much still hold true. He actually wrote a book about this that's a good read. It's fairly layman friendly. He's not alive, but Vanguard doesn't pay me to say this, but the book is called The Little Book of Common Sense Investing. And if you want to read that, it can really dig into his philosophy. The other big guy is Warren Buffett, who probably everybody who's watching this knows. And what Buffett does is he advises everyone to buy and hold the S&P 500 via a low-cost mutual fund or ETF. So basically, these two guys are the foundation of my idea that you should try to do low-cost as opposed to high-cost vehicles to express bets in stocks and bond indices. Anyway, so this is the attempt at humor. It really is simple. It's a piece of cake. That's pretty much all there is to what's going on behind your retirement investments. And I think that I'll talk about this more in subsequent videos, but really I think that people, if they knew about this, they could save a lot of money by potentially doing it themselves, which is part of why I'm doing this series. So anyway, I'll wrap it up here with this one, but I'll be back with some new videos, and thank you for watching.